Welcome to Vast Voice, the audio and video and social portion of vastsolutionsgroup.com. Today we're going to be talking about one participant 401k plans, or really owner only. Sometimes they're called solo 401ks, Uni-Ks, one participant Ks, etc., etc. My name is Kenner French. We're here to add some value to you, and we're going to get into it really quickly because we're going to add some value, and it's going to be in a big way. 401ks, as you know, you get a tax deferral when you put the money in. Obviously, the money grows, not worrying about it until you pull it out. As far as taxes, when you pull the money out, that's when you pay your taxes, typically at your current tax rate at that point. What happens when the money goes in? Deduction. Lowers your taxes. Instead of giving it to Uncle Sam, you get to pocket it. Get some growth rate on it. Good news. Here we go. The one participant 401k plans. Let's talk about that. It's not really a new type of 401k plan. Basically, what it is, it's a 401k plan though with no employees. It's a traditional 401k covering a business owner with no employees and or his or her spouse and partners. When I say partners, meaning business partners in this case. These plans, they have the same rules as any other 401k. That's important to remember. Now, let's talk about some of the contribution limits to a 401k that only has one participant. Again, even if we're talking about a spouse, that spouse still is considered, in the eyes of the IRS, Department of Labor, one participant plan, or again, solo 401k, solo K, Uni-K, or one par or one participant plan. The business owner wears two hats in the 401k. They're the employee and they're the employer. Contribution made to the plan, it can be made in both capacities, meaning as the employee or the employer. The employer can contribute both. So let's get into some of the specifics for 2020 as an example. Elective deferrals, they can be up to 100% of participation. What it's called is earned income in the case of a self-employed individual up to the annual limit. So for 2020, it's $19,500. Or it's actually $26,000 if you're aged 50 and above for, once again, for 2020. Now, let's also talk about the employer non-elective contribution, meaning the employer is putting the money in. So 25% of compensation as defined by the plan, or for self-employed individuals. We're going to get into that in just a little bit. But, by the way, if you exceed the limit for elective deferrals in your 401k, there are ways to correct that issue, and we can talk about some of the specifics if you call the office at 888-808-8278. You can discuss with any of the office staff. They have a good grasp on this stuff. Now, total contributions to a participant's account, not counting catch-up contributions, for those 50 and above, they cannot exceed for 2020 $57,000. No more than $57,000 can go into a plan participant. Again, not counting catch-up provisions for those who are 50 and above. So, why don't we go over some specific examples? Let's say Ben. Let's say he's age 51. He's earned $50,000 in W-2 wages. Let's say from an S corp. Let's say 2019. He deferred via a regular, what's called elective deferral, plus the $6,000 in catch-up provisions to a 401k plan. Now, his business contributed 25% of his compensation to the plan, $12,500 then. His total contributions to the plan then for 2019 were $37,500. This is the maximum that can be contributed for the plan for 2019 then, So now, let's say a business owner who's also employed by a second company and participates in its 401k plan. Now, you have to bear in mind these limits on elective deferrals are by the person, not by the plan. So, meaning you can only still put in those limits we've talked about. Even if you're in 10, 15, 20 companies, you still have to subscribe to those examples. Once again, to a participant's account, not counting catching contributions for those over 50 and above for 2020 can't be any more than $57,000. So, by the way, so a business owner who is employed by a second company, now it's obvious, there are maybe not obvious, but there's other things you could do to increase deferrals. You can combine plans, et cetera, et cetera. Once again, you can call the office. We can give you some specifics if you're interested. Contribution limits for self-employed individuals. Let's go over that a little bit. detail. You must make a special computation to figure the maximum amount of elective deferrals and non-elective contributions you can make for yourself. So, when figuring the contribution, figure the comp as earned income, which is, once again, defined by net earnings from self-employment income after deducting both 1/2 of your self-employment income tax and a contribution for yourself. And if you have any specific questions, once again, call the office, or you can go to the IRS publication 560, which is a great resource for retirement plans for small businesses. I would definitely suggest one taking a look at that publication 560. It's worth looking at. So why don't we talk about testing for a one participant 401k plan or Uni-K plan or what have you. So a business owner with no common law employees, so if you have no employees, you do not need to perform non-discrimination tests because you're just the only employee. So you don't have to worry about that. But now the no testing advantage vanishes if the employer hires any employees. Not good if that's the case. Obviously, I can't touch base about your business, but as it relates to the 401k plan, if that's the only goal in mind, probably doesn't make sense to hire employees because then you have to do testing and there's some very specific reporting requirements that are then due. So, no matter what the 401k plan is called, because it's called a lot of things by a number of plan providers out there, it's got to meet the rules of the IRS code. So if you hire an employee, again, no matter what the name is, and they meet plan eligibility requirements, remember, you have to pass tests. You must include them in the plan no matter what, and their elective deferrals will be subject to non-discrimination testing rules. So meaning there are certain tests that have to occur, and it's worth talking to your provider about some of those testing. Sometimes testing issues, sometimes they're not done appropriately, and they bring up potential audit flags, and you probably don't want that. Now, if you include eligible employees from your 401k plans, you make a mistake, there are remedies for that. And you can research those via Google or the web or specifically YouTube. We actually have something out there at vastsolutionsgroup.com. Check us out on the YouTube, how to correct a plan if there's been a mistake. And by the way, so a one participant 401k plan is generally required to file what's called a Form 5500 SF. S is in Sam, F is in Frank. If it has $250,000 or more in the assets, actually at any point during the year. A one participant plan with fewer assets may be exempt from the annual filing requirement. So what I would say is it really depends on the circumstance if this is a good idea for you, a 401k plan. But generally speaking, I'm going to say it's a good idea to have a 401k plan if someone's looking for current tax deduction. They have maybe $26,000, $25,000, maybe $19,000 if they're below a certain age. If they want to lower some tax liability and save for retirement, sometimes it makes a lot of good sense to adopt a Uni-K or 401k plan, etc. If you need any help, please give us a call, or you can check us out on the web, www.vastsolutionsgroup.com, or, of course, as I mentioned, give us a call, 888-808-VAST or 8278. Once again, it's Kenner French with Vast Voice. Good luck out there.